You know what I'm looking at right now? A crime scene, not a metaphor. An actual financial assassination happening in real time on Tuesday, February 17th, 2026 at 2 p.m. Brasilia time, while most of you are checking your phones wondering why your silver position just got gutted. The weapon, a second aircraft carrier, the victim. Every retail trader who thought war meant higher precious metals prices. The suspects. The same people who've been running this con since 1971, since 2008, since 2020, and especially since the 2024 Great Pivot when they rewrote the rules while you were busy watching TikTok. Before we go any further, the Suits and Legal want me to tell you this isn't financial advice. Of course, it isn't financial advice. It's a survival guide for a burning theater where the exits are locked and the fire marshal is taking bribes. This is pattern recognition for people who've been lied to by Bloomberg, by CNBC, by every talking head who told you inflation was transitory while your grocery bill doubled. Do your own research. If you still trust the people who stole your purchasing power, who printed 40% of all dollars in existence in 2 years, who told you everything was fine in 2008, right before Lehman Brothers vaporized. I'm just reading the data they don't want you to see. So here's what happened today. Silver crashed to $74.83, down over $3 in a single session. Not slowly, not gradually. A vertical drop that triggered every stop-loss order from here to Shanghai. And at the exact same moment, Kitco and Bloomberg and Reuters all published the same story with slightly different headlines, but identical content. United States deploying second aircraft carrier to the Middle East. Iran conducting military drills in the Strait of Hormuz. Tensions escalating. Geneva talks stalling. War drums beating louder than they have been since the 2025 bank shocks when 3 regional banks failed in the same week. And the Fed had to activate emergency lending facilities that technically don't exist on any official balance sheet. Now pause. Think about what I just said. War escalation. Second carrier group, Iran, doing military exercises in the choke point that controls 21% of global oil supply. That's not my number. That's the EIA's number. The Energy Information Administration, the same people who track every barrel moving through every straightened pipeline on this planet. And silver, the metal that's used in every missile guidance system, every solar panel the military is installing on forward operating bases, every electronic warfare suite on every F-35 that just got scrambled to the Persian Gulf. That metal crashed $3. Does that make sense to you? Because it doesn't make sense to me. And I've been doing this since before the 2008 crash, when I was watching Bear Stearns trade at $2 a share, and everyone on CNBC was saying it was a buying opportunity. I watched 2020 when they shut down the conchs and premiums went to 10 over spot because there was no physical silver available anywhere. I watched 2024 when the Basel IV regulations were supposed to change everything, and instead the banks just got bigger exemptions. So when I see war and crashing silver prices in the same headline, I don't see confusion. I see a setup. But before I explain exactly what's happening and why you're about to witness the greatest wealth transfer in precious metals history, I need you to do something. The algorithm is burying this content. I'm not being dramatic. Check the view count versus the subscriber count on any video I've posted in the last 90 days. YouTube's 2026 shadow ban protocol is real. They've admitted it in leaked internal documents that got published on Substack last month. Videos with certain keywords, war, silver, manipulation, Federal Reserve, those get suppressed in recommendations. So smash the like button. Not because it helps me, because it breaks the suppression algorithm. Every like signals to the system that this is content people want to see, and it forces them to recommend it to more people. We're fighting a war on multiple fronts here, and one of those fronts is information itself. Now, let me show you what's really happening. The news cycle says second carrier deployed, USS Gerald R., forward carrier strike group. That's not just a ship, that's 11 vessels. The carrier itself, 2 guided missile destroyers, 1 frigate, 2 Los Angeles-class submarines we know about, and probably 1 Virginia-class we don't, plus supply ships and support craft. That's a city floating toward the Strait of Hormuz. The annual operating cost of one carrier strike group is $6.5 million per day. That's not including the aircraft, the munitions, the fuel for sustained operations. When you deploy a second group, you're committing to spending at minimum $13 million every single day just to keep those ships in theater. And Iran knows this. They're not stupid. They've been preparing for this exact scenario since the 2020 Soleimani assassination. That's why they're running drills right now, not exercises. Drills, that's a specific term in military language. Drills mean rehearsing an actual operational plan. They're practicing swarm attacks with fast attack craft. They're testing their anti-H-ship cruise missile batteries on Keshem Island. They're running submarine operations in the shallow waters where American sonar has trouble tracking them. This isn't posturing. This is preparation for kinetic conflict. So let me ask you again, why is silver crashing? The metal that goes into every weapon system, every guidance chip, every radar array, every solar panel that powers drone bases. Why is that metal going down when the probability of war just went from 30% to 70% in the span of 6 hours? I'll tell you why. Because the price you see on your screen, that's $74.83, that's not the price of silver. That's the price of silver futures contracts. Paper promises, derivatives, rehypothecated claims on metal that doesn't exist in the quantity being traded. Let me show you the math, and you're going to do this with me because this is important. Open interest on COMEX silver futures as of yesterday's close on 183,422 contracts. That's a Ponzi scheme with a CFTC license. And today, what happened? Long liquidation. That's the technical term. Traders who bought silver futures contracts at $78, at $70, at $80. They're holding those positions on margin, borrowed money. When the price drops to $77, their broker calls them and says, you need to deposit more cash to maintain this position. Margin call. If they can't deposit that cash immediately, the broker liquidates the position, automatically sells it into the market regardless of price. And that selling creates more downward pressure, which triggers more margin calls, which creates more forced selling. That's a liquidity cascade. That's a V-shock. That's the same mechanism that crashed oil to negative $37 a barrel in April 2020, when the storage facilities were full and the futures contracts were expiring and nobody could take physical delivery. I read the geopolitical reports, so you don't have to. I'm scanning Reuters and Bloomberg and Kitco and the actual Pentagon briefing transcripts that get published on defense. Gov 3 hours after the press conferences. I'm watching Iranian state media IRIN and reading the translations. I'm tracking the automatic identification system data for tanker movements through the Strait. This isn't entertainment, this is intelligence gathering. And if you want me to keep doing this, if you want someone actually reading the source documents instead of just repeating what some anchor with a teleprompter says, hit the super thanks button. That's the only funding model that works when YouTube demonetizes every video that mentions war or markets in the same sentence. So let's talk about what really happened overnight. Geneva talks, United States and Iran officially about nuclear program monitoring unofficially, about oil sanctions and frozen Iranian assets in Western banks. The talks stalled, not failed, stalled. That's important language. Stalled means they're still negotiating, but they've hit an impasse. And the moment those talks stalled, I started watching the futures market because I knew what was coming. The military moves first, the press releases second, the market third. That's the sequence. Always has been. At 11:47 p.m. Eastern Time last night, silver futures started dropping. Not a lot, just 60, but the volume was wrong. 3 times normal overnight volume. Someone was selling large positions. Not retail, not some guy in his basement panic selling his 10 contracts. This was institutional. You could see it in the order book. Large block trades, 50 contracts, 100 contracts, 200 contracts at a time, all hitting the bid, all driving the price down. Now, tell me in the comments what premium you're seeing at your local dealer, not the futures price, the actual cash price for physical silver. American Silver Eagles, Canadian Maples, generic rounds. So what's happening in the physical market? Demand is skyrocketing. I'm talking to dealers I've known for 15 years, and they're telling me things I've never heard before. One guy in Texas told me he sold more silver in the first 2 weeks of February 2026 than he sold in all of fourth quarter 2025. Another dealer in Pennsylvania said he's got a waiting list for Silver Eagles. A waiting list. You don't get waiting lists for precious metals unless there's a structural shortage. The U.S. Mint production numbers for January 2026 showed 3.8 million Silver Eagles produced. Sounds like a lot until you realize that in January 2024, they produced 5.2 million. And in January 2025, they produced 4.6 million. Production is declining while demand is spiking. That's not a sustainable situation. And let me connect some dots for you, because this is where it gets really interesting. The U.S. Mint buys its silver blanks from private refiners. Those refiners buy their silver from mines and from recyclers and from dealers. But there's a lag time. It takes 60 to 90 days from the refiner purchasing the metal to the mint producing the coin to the coin hitting the dealer's inventory. So the production numbers we're seeing now in February 2026 reflect the silver that was purchased in November and December 2025, back when spot price was $68. Now, spot is $74 and premiums are $7, and the total acquisition cost for a dealer is $81 before their margin. If spot goes to $85, which I think is highly probable, if Iran closes the Strait, that dealer loses money on every coin he sells at 82s. This is the mechanism they don't want you to understand. The paper market and the physical market used to be connected. Used to be that if COMEX price went up, physical prices went up proportionally. If COMEX dropped, physical dropped. That correlation broke in 2020, and it hasn't been restored. In March 2020, silver futures crashed to $11.77. Physical silver was selling for $18 to $20. In 2024, during the Shanghai Gold Exchange arbitrage crisis, COMEX was showing $72 and physical was $78. Now we're at $74.83 paper and $82 physical. The spread is widening. That's called backwardation. That's called market failure. That's called the system is breaking and everyone is pretending it's normal. Subscribe to this channel if you want updates when the Strait of Hormuz closes. Not if, when. I'm tracking the ship movements. I'm reading the Iranian press releases. I'm watching the insurance rates for tankers. War risk insurance for a VLCC. That's a very large crude carrier. Going through the Strait right now is 0.85% of cargo value. That's up from 0.12% in January. When that number hits 2%, tankers stop going through. When tankers stop going through, 21% of global oil supply gets cut off. When that happens, oil goes to $150. When oil goes to $150, inflation comes back harder than it did in 2021 to 2022. When inflation comes back, the Fed has to choose between saving the economy or saving the dollar. And they'll choose the dollar every single time because that's their mandate. That's what they did in 1980 when Volcker raised rates to 20% and killed the economy to kill inflation. Now, let me show you the technical picture because this is where it gets really precise. We touched $72.50 overnight. Exactly $72 high. That's not a random number, that's algorithmic support. High-frequency trading systems have predetermined levels where they start buying. Those levels are based on Fibonacci retracements, moving averages, previous consolidation zones. 72.50 represented the 38.2% 2% Fibonacci retracement from the low of 62 in December 2025 to the high of 84 on February 3rd, 2026. When price hits that level, algorithms start buying, not because of fundamentals, not because of supply and demand, because that's what they're programmed to do. And we bounced from $72.50 to $7,483 in less than 4 hours. That's not retail traders carefully analyzing the market and deciding it's a good entry point. That's algorithmic buying. That's programs executing thousands of buy orders per second. That's the machines taking control of the market. And here's what the machines don't know. They can't account for force majeure. They can't price in the probability of the Strait of Hormuz being closed by Iranian naval mines. They can't calculate the impact of a U.S. destroyer being hit by a Sunburn anti-H ship missile. Their models are based on historical data. And there's no historical data for 2026 because we haven't lived through 2026 until right now. So what do I think happens? I think we're in the final shakeout before the war premium kicks in. I think the weak hands got liquidated today. I think everyone who was trading silver on margin, who couldn't handle the drawdown, who got scared when they saw $74, they're out now. They sold. They took their losses. They're done. And that creates space for the next move higher. Because when the first missile flies, when the first tanker gets hit, when Lloyd's of London declares the Strait of Hormuz a war zone and insurance becomes unavailable at any price, spot is going to gap up $10 in a single trading session from 74 to 84 overnight. And you won't be able to buy physical at any price for weeks. I'm adding to my long position here. I'm buying physical silver at $82, knowing full well that paper price is $74. Now, why? Because I don't trust the paper price. I don't trust COMEX. I don't trust a system where 19 paper claims exist for every ounce of physical metal. I'm buying the thing itself, the metal in my hand, the asset that can't be rehypothecated, can't be printed, can't be diluted by some Fed governor deciding we need another $3 trillion in quantitative easing. And if you want to copy my trades, if you want to see my exact entries and exits and position sizing, join the Insider Tier membership. That's the only way I can share specific trade recommendations without violating securities regulations. But let me be very clear about something. This isn't about making money. I mean, it is. We all need to survive in this system, but that's not the primary goal. The primary goal is preserving purchasing power through the collapse because that's what's coming. Not a recession, not a correction to collapse. The United States government is running a $36.4 trillion debt. That number was $28 trillion in 2020. We added $8 trillion in 6 years. The annual interest payment on that debt in fiscal year 2025 was $1.2 trillion. That's more than we spend on defense, more than we spend on Medicare, more than we spend on Social Security. We're paying more to service our debt than we're paying for any actual government function. And how do we pay that interest? We borrow more money. We issue more treasury bonds. Let's talk about what's really happening in the world. Who's buying U.S. government debt? Now, the answer is fewer and fewer foreign central banks. China's holdings of U.S. treasuries peaked back in 2013 at $1.3 trillion. As of late 2025, they're down to just 796 billion. They've been selling for 12 straight years. Sure, Japan is still buying, but they're the only major player left. Everyone else, they're rotating into gold. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the 23 countries that joined them in 2024 and 2025, are building a parallel financial system. They're settling trade in their own local currencies and using gold as the ultimate settlement layer. They are systematically cutting the US dollar out of the equation. When the dollar finally loses its reserve currency status, all those trillions held overseas will come flooding back to the United States. This is called reverse capital flow. It's what happened to the British pound after World War II, and it's happening to the dollar right now in slow motion. When those dollars come home, when foreign central banks dump their treasury holdings, we're going to see inflation that makes 2021 look like a picnic. I'm talking 15 to 20% annual inflation. Your rent doubling in 3 years. Ground beef at $25 a pound. The complete destruction of middle-class purchasing power. So, how do you protect yourself? You hold hard assets. Real estate is great if you can afford it, but it's expensive and not easy to sell quickly. Gold and silver, on the other hand, are portable, divisible, and carry no counterparty risk. They have been recognized as money for 5,000 years across every civilization. When Rome fell, gold held its value. During Germany's hyperinflation, gold held its value. When Venezuela collapsed, gold held its value. Paper currency always goes to zero eventually. The metal never does. Now, let's connect this to what's happening in the news. Why does the US have 2 carrier strike groups in the Middle East right now? The official story is to deter Iranian aggression and protect shipping lanes. The real answer? The entire global economy depends on oil flowing through the Strait of Hormuz. If that flow stops for even 2 weeks, we're looking at a recession that makes 2008 seem like a minor hiccup. 21 million barrels of oil pass through that strait every single day. The world consumes about 102 million barrels daily. Cut out 21 million, and you have a 20% supply shock. To put that in perspective, the 1973 oil embargo cut supply by just 7%, and it caused gas lines, rationing, and a decade of economic stagnation. A 20% shock would be catastrophic. Iran knows this. They know the strait is their ultimate leverage. Closing it would hurt the West far more than it would hurt them, since they can sell their oil overland to China through pipelines. They don't need the strait like Saudi Arabia, Kuwait, and the UAE do. So, if the US or Israel attacks Iranian nuclear facilities, Iran's logical response is to close that strait. It's their only strategic option. What happens to silver when oil spikes to $150 a barrel? Industrial demand might dip as factories slow down, but investment demand will skyrocket as people panic and rush to safe havens. Fear is a much stronger motivator than industrial calculation. We saw this in 2020. Lockdowns crushed industrial demand, but retail investment demand was so high that premiums hit $10 an ounce and delivery took 8 weeks. The same thing will happen again, but this time it will be worse, because people will know it's not a temporary problem, it's a structural shift. Let me give you 3 historical examples. In 1979, after the US embassy seizure in Iran, silver went from $6 to $50 in 18 months, a 733% increase. In 2008, after Lehman Brothers failed, silver first crashed from $20 to $8, then soared from $8 to $48 by 2011, a 500% rally from the bottom. In 2020, with the COVID lockdowns, silver crashed from $18 to $11, then shot up to $30 in just 5 months, a 172% gain. The pattern always repeats. A crisis, panic selling, a bottom, and then a moonshot as everyone realizes physical assets are the only safe haven. We are seeing the exact same setup now. The initial panic selling already happened. What comes next is the capitulation, where prices might dip a bit further. And then comes the reversal, when everyone finally grasps that war is coming, oil is going to spike, inflation is returning with a vengeance, and the dollar is being systematically destroyed. Let me know in the comments if you're seeing delivery delays at your dealer. Are they telling you 2 weeks, 4 weeks, 6 weeks? That's the real signal. The paper price can be manipulated, but the physical market tells the truth. If you can't buy metal near spot price, if you have to wait weeks for delivery, it means the system is breaking. And when I say the system is breaking, I mean it literally. In March 2020, the COMEX Futures Exchange failed to deliver physical silver to contract holders. They had to change the rules mid-crisis to save themselves. That was the warning shot. Now, in 2026, the same dynamics are playing out, but the stakes are much higher. This is the everything crisis. The government has 2 choices: stop printing money and default on its debt, or keep printing and hyperinflate the currency. They will choose inflation. Every government in history does. It's politically easier to blame rising prices on corporations or foreign adversaries than to admit they are robbing you through monetary policy. Here's what I'm watching for in the next 48 hours. First, tanker movements through the Strait of Hormuz. If insurance costs rise and ships start rerouting, the market is pricing in a closure. Second, COMEX inventory reports. If we see large withdrawals, it means the smart money is taking physical delivery. Third, premiums at major dealers. If they start jumping, it's a sign of retail panic buying. And fourth, the Geneva talks. If they collapse, the probability of military action becomes almost certain. My base case is limited U.S. strikes on Iran within 30 days. Iran responds by closing the strait, oil spikes to $140, and silver follows, hitting $95 within 60 days. The Fed will cut rates even with rising inflation to manage the debt, and the dollar will begin its terminal decline. Even if a deal is reached and prices drop temporarily, the fundamental problems remain. The debt is unsustainable, and the currency is being debased. That dip would be a buying opportunity. Either way, the strategy is the same. Accumulate physical silver and gold, hold dollars only for short-term needs. Get out of variable rate debt. Your cash savings are being devalued every day. The official inflation number, the CPI, is a lie. They changed the formula in the 90s to make it look lower. Real inflation has been much higher than reported. This is the real war. A war on your purchasing power, on your ability to save, on the middle class. So what should you do? Buy the dip. Buy physical metal while you still can. Focus on accumulating ounces, not dollar values, because the currency is temporary, but the metal is permanent. When the crisis fully hits, you won't be able to buy silver at today's prices. You'll be on a waiting list, wondering why you didn't act when you had the chance. Don't be that person. History rewards those who were right and took action. I'm buying here. I'm watching the news cycle for confirmation. This is the trade of the year, where geopolitics, monetary policy, and supply constraints all point in the same direction. Make sure you subscribe and hit that like button to fight the algorithm that tries to bury this kind of information. Thanks for watching.